Hi, I'm Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. Today, we're just going to do a quick overview of the economy, just given the PMIs that just came out. Go a little bit deeper into China, what's happening there on an economic level. Look at where are APIs, what is an API, what does API gravity mean, and then obviously our favorite, the primary vision Frac Spread Count. So just diving into what's going on in the world today, on the economy show, we're going to go into a bit more depth and unpack some of this information. So today's just going to kind of be a little bit broader overview. The IHS market composite for the US came in at it actually missed estimates. And this is an important distinction because the expectation was for us to get to about 51. Instead, we came in at about 50.2. Now, just so you understand, 50 just means there was no change month over month. So if you're below 50, you're contracting. If you're above 50, you're actually expanding. But again, there's a certain amount of give and take between there. So between, let's call it 49, 51, you're kind of just bouncing along and trying to, remain consistent. The problem is the depth in which we fell means that as we start to aggregate this data, we're still on a net contractionary level. And when you consider what we look like as we leave July, looking into August, we have an increase in lockdowns, we have some slowdowns in terms of where consumer spending is going to be. And, the question is going to be, what does back to school look like? What is there going to be this big surge in spending? And these are things that we're going to talk about more as we get into our Wednesday and Thursday shows, looking at where's the economy, how are things looking going forward. And you can see, obviously, the GDP numbers, for Q1 were weak, Q2 is going to be similar. And then the question is going to be, what does Q3 really look like? And that's why when we turn to Germany, France, and the EUROZONE, they had a relatively good number. And this is something that's nice to see. We came in north of, call it anywhere between 54 and 55. France surprised the upside at 57, and they beat estimates. But this is a great trend to see. You might say, well, why are they outpacing the U.S.? And the answer is because they went much deeper. Their recession or their pullback was much sooner than ours, just given where COVID, really started, how things adjusted, and they've been able to maintain, a relatively better reopening and in terms of spread of the illness. So here you can see that this is something that we have to watch because this is a positive. This is something where, okay, well, what are exports doing? What are imports doing? Are we starting to see this really catch on? And this is a bright spot that is something that we need to really see to continue. And this is, again, something that we're going to focus on a bit more in the economy show. But, to counteract some of that good news is, the South Korean data. So they technically have now officially entered into a recession, which based on just economic terms is two consecutive quarters of negative growth. So the first time that they've had this a technical recession was in 2003. So the problem is, and here you can see 2003 where you had those two consecutive quarters of negative growth. You can see the size and the difference between 2003 and 2020. And, the one thing that we're going to look at as we kind of go forward is, are we seeing anything to change that? Are we seeing imports, exports pick up? And the short answer is they're picking up, but nowhere near to kind of, right this wrong in terms of where we sit on that GDP growth. And when we think about, okay, well, who does South Korea trade with? And, they're big tech, they're big in the tech world, they're big in shipbuilding, and they have a very healthy relationship in terms of trade, not so much politics, with China. And that's where we turn to China and we look at, okay, well, what is happening within China? Are we seeing any type of growth? And this is just one example of the anchorage that we've seen. And we've been talking about the amount of oil sitting offshore Chinese, the China coast. And here you can see we're going right back up. We're now at about 30 vessels. Now this Qingdao is where the Shandong independent refiners are teapots. So this is a big area because this is some place that really kind of led the charge coming out of COVID in terms of getting those refinery run rates back up. But now we're starting to see a huge saturation, which, China has turned around and resold some of these cargoes to South Korea, which is what that dip was. And it's just because they're so flooded with oil, and they're turning around and dumping a huge amount of refined product into the market just because they're saturated. And when we talk about saturation, we talk about this, it's good to visualize, because to resell something to South Korea, you kind of see that you're really not going all that far. So it makes sense to kind of see this back and forth between China and South Korea. This is a bit broader because you can see where all of the crude vessels are. You can see the size. The Shandong, where if we kind of zoom in, you can see that 44 and 28. Those are the vessels that are either currently in transit, getting into port and waiting. The problem is this isn't going to clear anytime soon because there's a huge amount of bottlenecks that remain at the port level as they continue to stress testing for COVID, trying to make sure things are getting better in terms of making sure that there isn't another spread of COVID within China. But it's also a way to kind of hide, well, how are imports and exports actually doing within China? Because this is going to be a huge impact for how much oil are they going to import from the US? How many products are they going to import from the US? Like what does that relationship look like? As we already know, on a diplomatic, political, and military level, things are devolving quickly. And that's when we turn to trade. And I shouldn't say funny, but the interesting thing here is, about $1.5 trillion worth of trade they're currently in some sort of political battle with, the US, Japan, South Korea, Hong Kong, Germany, Russia, all of these countries, Malaysia is another with the South China Sea, the 9-dash line. So there's a huge amount of economic impact that could come with how is this going to escalate over the next coming months, because there's a huge amount of total trade. This is total imports and exports that they rely on to get things into market. And you can see, 2019, there's been a negative trend. And obviously you had the increase of the trade war, then the trade deal. But again, this is really kind of putting into context what things really looked like. And if we turn to Q1, you can see the decline. And obviously the decline January into February, February into March, that was core COVID from a Chinese level. But we haven't seen much really kind of turn the other way, because obviously their trade partners remain under significant stress. And these are things that are going to remain, which is why we continue to look at what's happening, not only on what are the boats saying, which we've already seen, May was printed the lowest that we've seen. It was down 11% on global trade. And that's something that, it won't be 11% in June or July, but again, we're still not going to be in that positive growth level. And you're seeing it here. And as politics continue to get in the way of kind of where the products are going, that's going to be something that's going to be problematic as we look towards GDP. And that's why the Ladakh update, is going to be relatively short. There's been a kind of a reversal, and not really an aggressive reversal in terms of moving people back to that LAC or the line of actual control between China and India, but it was a movement really of airplanes, fighter jets, helicopters, support, really just aircraft. Aircraft is moving in, and it's not moving to the front lines, but again, it's an aircraft. It can go at, Mach 3 type thing. It doesn't have to be there, but we're seeing it move into place to be within striking distance. So this is something that we're always going to keep our eyes on, just because this is a huge flashpoint, especially as China and India continue to kind of go tit for tat on this hot button issue. Now it's time to turn to crude quality. Now, if you watch the conversations we had with Fernando Hernandez, we talked about API gravity and why that's so important. And API gravity is just, what is the viscosity? What is the thickness of the oil that's coming out? Because you have to prepare the refiner and the pet chem to handle all different types. So when we look at, okay, well, where is the US competing? Where are we looking? We have to consider what all crude grades look like, especially with, someone like, as we talked about earlier with Shandong in China, with about 48 million barrels onshore, not including what's offshore. You have to consider, it's like, okay, well, who are we competing with and how can we compete with them? And when we turn to Europe, we have to look at it. It's like, okay, well, what's happening in Russia right now, right? Russia, you can see in between July and August, they're increasing production, or I should say exports in August. Production is one thing, but exports are supposed to increase 42% for Urals between July into August. This is about, let's call it 1.1 to 1.2 million barrels a day of additional exports from July. So you can see here in terms of those lines coming down, that's where the green line, the yellow line, and that let's call it light yellow line are really the where that Urals are going to come from and get into the market, and that's going to shift higher. So essentially, those bottom four lines are now you're essentially going to jump back up and compete with CPC. So this is where Russia's starting to normalize. And the commentary has been, well, Saudi Arabia, Russia's going to consume more domestically. But realistically, in terms of how Russia is doing right now, that's going to fall into the market. That's really going to get pushed into the market. And that's what we're seeing here with their exports increasing 42%. The reason why we talk about China in this conversation is because a lot of this was going into China, was going into India, and it doesn't have that kind of capacity. So a lot of this is going to turn back to Europe. And this is where a lot of that US crude was going, and it's going to be hard to compete at this point in time, just because the Ural is going to find a little bit better home, just given kind of where the crude qualities are and really what cost is. So this should really bring prices down. And the reason why we talk so much about Urals, about API, we hear in the news all the time how, the US is now fully energy independent. Well, that's not true. It's not true because we don't produce the right kind of oil for what we need to what our refiners are built to consume. And here's just a perfect example. If we just look at Texas, the growth has been in that 40 to 50 API range. So now that just means it's light and sweet. Now light is again, just, if you think about light versus heavy, that is where we're going to define that API gravity. Light just means it's more like water. It's not the viscosity is less, where the heavier you go, it's more like molasses. The higher you go, it's more like water. And then the sweet versus sour is the sulfur content, because you have to treat the sulfur differently, as you can't just pump sulfur into the atmosphere, because then if we complain about greenhouses before, it'll only get worse with that now. So that's why we have to look at, okay, well, the US has to export this. We can't consume it locally. You have some refiners that are spending billions of dollars to adjust their processes to try to take in more of this. But again, it's going to go into Europe. It's going to go into India. It's going to go into Asia. And that's why we talk so much about the Chinese trade deal, the Chinese trade war with the US, because the hope was it was going to go there. They were going to have this demand. Instead, we're going to have to focus more on, can this go into Europe? And where's Russia? Is Russia going to compete? Can we compete in there? And that's a bigger problem. And that's why when we look at things on this crude blend, and now this is a chart that's looking at from heavy to light on that bottom axis. And then when we're looking, sweet to sour. So that's why we need to see, it's like, okay, well, where can we compete? Can we blend things together? And that's why when we look at Brazil, Vasconia, and Lula, a lot of that product was going into China. Now, obviously, China's swamped, so it's going to turn back into the U.S., which is good for U.S. refiners, because this is, as you can see, it's not only sweet, but it's also heavy to medium, which is going to be great for the blending. But we have to continue to push our Texas-made crude or Texas-produced crude into a different market to kind of free things up. And this is just giving you an idea of what kind of refinery inputs are we seeing. And if you just go to April, you can see across the board we average about 34. So if you go back to that Texas chart, we're producing an increasing amount between 40 and 50, which means that we have to blend that crude to bring it down to a level that can be consumed, or it has to be exported. And then if we're exporting it, that means we have to import someone else's crude. So you kind of see how there's always this circle in terms of where we're always relying on crude coming in. And to kind of focus in and hone in on pad 3, as we talked about in the conversations with Fernando Hernandez, we talk about, well, this is why the Gulf of Mexico is so important. It has a heavier crude that helps us offset the need for some of these imports. Because you can see, we average anywhere between 30 and 35, give or take, depending on what we're trying to produce. And this is why we need to rely on some of these imports. And that's why when we talk about different things, like right now, Hannah's coming into Texas, they're talking about halting ship activity and Friday to about Sunday, depending on, the speed in which it moves through. So Port of Corpus Christi is already preparing for shutdowns, and you're starting to see these adjustments for weather. And this is why you get these blips. These are the kind of issues where it's going to impact our exports, it's going to impact our imports, which is going to impact the way we can produce things in the short term when you have weather related issues, but over the longer term in the sense where we just don't have the right crude quality to feed the beast. And maybe we can build more pipelines, bring in oil sands. We can optimize some of the heavier crudes, specifically in California or in the Gulf of Mexico. It's just, is there an environmental political appetite, and does it make economic sense? And that's some of these issues that really kind of drive, where is the frac spread going? Is there money to be made in that frac spread? And that's some of those things that we're always going to talk about and look at as we go through what the spread count is for this week. Now that we've gone through some of those nuances about API gravity and what's happening within the U.S. in terms of refinery throughput, we get to jump to our favorite segment, the primary vision frac spread count. So this week we came in at lucky number 80. So last week we were at 67, coming in at 80, which was, if you think about where we've talked about in terms of confidence range, where we think the 4-week average is going to kind of sit, this makes a lot of sense. We've talked about last week how we were going to see some Permian activity, and that did come through. So we did have an increase in the Permian, but again, the one thing that's interesting in this, typically on a seasonal level, August goes down, but because of COVID, because of some of these delays that we saw through June, July, and obviously the recovery in some of those front months, we're starting to see that the kind of shake a little bit, and we think we're going to continue to see an increase specifically in the Permian through August. The other thing that's interesting, and it's one of those little tidbits, when we look at rig counts, rig counts went down 20 straight weeks, consecutive weeks. And it started March 6th, but when you consider why we're starting at March 6th, we had an increase of 1 during that time period. So that's why it's probably a little bit longer, but just consider how contiguous that is in terms of those moves lower, which is interesting, especially because last week we talked about how rigs were going to start to hit a bottom. Technically it was net down, but that was more driven by gas, not oil, because oil actually went up by 1. So it's interesting because we're starting to see some of these things normalize a bit. Again, we think that we're going to kind of keep that 4-week moving average or so between that 74, 75, and that 65 to 80 is going to kind of 85 is going to kind of be that 20 range, that 20 spread range. And the reason why we're saying that, because now when we look at kind of where we've sat since really going back to May 1st, you kind of see we bottomed out and we've been kind of waffling within this range. And it's really kind of driven based on Appalachia, and some of these other gas basins have been kind of holding steady. There hasn't been too much. There's, increases of 2, decreases of 3, you're kind of sitting within this level, even though when we look at some of these estimates for October storage, there's talk that we're going to break records in terms of natural gas and storage. But next week we're going to talk a little bit more about LNG, some cancellations. What does that mean? But when we look at the frac spread count and we see we're sitting at 80, and that which is why like 67 to 80, we don't think in the next week or two we're going to fall back below 70. We think we're starting to kind of see that hold in here, and it's really driven by some of these private entities. We have some of these private E&Ps that are picking up some spot contracts and some of the fringier acreage, but again, starting to see some of that reactivity just because pricing has come down. We've seen some assimilation with, let's just call it additional cost savings, and just pricing just coming down just to kind of keep things working forward. Because again, like as we continue to talk about, it's going to matter in terms of how do I prepare my decline curve? Where do I want to exit 2020 to go into 2021? And those conversations are happening now for the second half of the year. So these are things that are going to kind of continue to weigh on decisions on not only at the OFS side, but also the E&P side. When oilfield services, how low am I willing to go? What kind of spreads do I have available? How much horsepower do I have available? Is there something that I can work a deal out to get an additional completion job or to keep guys working for an extended period of time? And the E&Ps are looking at it like, well, where am I hedged? Where's my pipe? What's my pricing? Does this make sense given kind of where I sit and how I want to plan going into 2021? So these are things that we're going to continue to talk about, write about. Next week, we're going to have some great shows again with the EIA report. The economy, one of our favorite shows that we think is going to be a big winner. And then if we have an OPEC update, we're definitely going to do something on the geopolitics, but if OPEC does anything, we're going to cover that. And then obviously on Friday, rounding it out with our primary vision frac spread count. So thanks again for watching. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. Have a great weekend.